Hi there, welcome to Nippy Invest. In today's video, I'm going to be focusing on a small cap energy company called Klima Energy. This company has assets based in Canada, British Columbia, and Alberta. And the energy sector has been the best performing sector since the start of the calendar year. So you would think that Klima Energy has been performing well in terms of the share price, but it has not been the case. So that is telling me either the market is missing something here and hasn't discovered this company, or the market is concerned about something when it comes to Klima Energy. So when I had a look at their quarterly report for the March quarter, it was fascinating that this company is operational cash flow positive by over $10 million. But on the flip side, they are not free cash flow positive, which means they are spending a lot of money when it comes to capital expenditure. But when I went through the activities report, there were some fascinating little tidbits in that. In particular, they are planning to issue dividends and bring in a share buyback, which means management are either anticipating a lot of cash flow flowing into this company in the future. And it's really fascinating because it was only January or February this year that the company did a $20 million capital raising, and now they're starting to give money and buy back shares. So something has either really changed for this company, or the capital allocation decisions by the management have a lot to be desired. And I'm not sure what the answer is with this company right now. And I'll talk about that as we go through the rest of this video. I love these sort of slides. I did find in one of Klima Energy's presentations, because it tells me what this company does. They are a conventional oil and gas producer, and where their assets are located in Alberta and British Columbia in Western Canada. So they have three main assets, one near Calgary called Brooks, which is just under my head, one near Edmonton called Thorsby, and one in British Columbia to the northwest of Thorsby called Montney. And this just gives us a better insight on what a company does. And in my opinion, most companies should release presentations on what they do to the market. And I don't understand why they don't, because it's a great selling point. And it also helps investors understand what a company does. The other thing is this particular slide gives us as investors is their plans for the future. They also talk about responsible capital allocation. And in my opinion, that is one of the main jobs of the management of a company, is responsible or really good capital allocation. So they describe why they're being responsible when it comes to capital allocation. For instance, in Q3 2020, they're going to include 4 new wells that will commence in June 2022, which should add cash flow to the company. So a lot of information in this one particular slide about Klima Energy. Now, Klima Energy has been on the ASX for a while under different names, but it really was in February 2021 when this company made it. And this was a merger with another company called Black Spur Oil Corp. And to be honest with you, Black Spur Oil Corp was the major party to this merger. And that becomes quite apparent when the founder of Black Spur Oil became the CEO of Klima Energy. And also I think there were two of the main assets that Klima Energy has were Black Spur Oil Corporation assets. So I think this was more of a case of Black Spur Oil wanted to be a publicly listed company, and they found an opportunity to merge with Klima Energy. So really, you're buying into Black Spur Oil Corporation in the vision the management of that company has for the future. Now, just a few facts in regards to Klima Energy. Of course, they're into oil and gas or energy, and this is a booming sector right now, the best performing sector on the ASX and more than likely on most international equity markets. Company was actually founded in November 2005, but under different names, and actually listed in July 2006 as Rialto. They changed the names to Zonto in 2013, and then to Klima Energy in 2017. Now, during that 11-year period from when they listed to when they became Klima, this company was trying to get into different areas. For instance, at one point in time, they were trying to get into Ghana, mining who knows what. So I sort of skipped all that. And they tried to find their mark in energy in 2017 when Zonto actually bought a stake in Klima. The current CEO is Jordan Kaval. He is the founder of Blackspur. So again, I believe this is more of a Blackspur story, but it is a merger. So you've got to look at also what Klima brought to the table, which was that one asset. And the market cap of this Klima, this combined entity, which is Blackspur and Klima, is currently $120 million at 20 cents. And the ticker code for this company is CE1. Now let's have a look at the financial state of Klima Energy based off their financial year 21 numbers, which were released in February of this year. So Klima Energy's financial year is identical to the calendar year. Revenue, 38.6 million. Operating cash flow, 16.5 million. So I could have stopped right there and thought, wow, this company is significantly cheap with a market cap of only 120 million. However, they were unprofitable by 32 million, but that doesn't really tell us something because they could have written down something which would have led that to be a really big number. And more than likely, that's why that was negative 32. So again, don't just look at the profit of this company and take away that this company is losing or draining a lot of money out of its business. That's not exactly true. Net debt, 27.8 million. I would prefer that to be closer to zero, but they are working on decreasing that based off the commentary in their activities report. Capital expenditure, 20.1 million. And this is where it's very important. So this company was not free cash flow positive in financial year 21. To get the free cash flow of the company, you take away the capital expenditure from the operating cash flow. So in fact, Klima Energy was free cash flow negative by $3.6 million. Enterprise value, when you add the debt or net debt to the market cap, is 148 million. And one of the valuation metrics I do use is enterprise value to operating cash flow. And at 9, that's sort of average, not too low, not too high. So just based off the financial year 21 numbers, the operating cash flow, enterprise value, I would not say this is a cheap company at this point in time or at that point in time. Now let's have a look at the quarterly reports for Klima Energy. Before we have a look at the most recent March quarter, I'm just going to go back 1 year ago and look at the March quarter for financial year 21. And this is just around the time there was that merger between Klima and Blackspur. And you can see when you compare the two March quarter results, how this company is primarily a Blackspur oil company, not Klima Energy, because in the March quarter of 2021, Klima Energy only brought in $99,000 of receipts and was operational cash flow negative by $138,000. So very unimpressive results from Klima Energy just before this merger with Blackspur. And as we now focus on the March quarter for financial year 22, the most recent results from Klima Energy, a lot to like here when we look at the cash flows from operating activities. Receipts from customers, 30.9 million, and the company was operational cash flow positive by $11.1 million. You also notice here, there was an other section here, losses on risk management contracts, changes in non-cash working capital. That was negative 6.8 million. So it could have been better if there wasn't that other section here. I'm not sure what that other section exactly was. I would like a little bit more clarity by what led to that $6.8 million a loss in that other section, but we didn't quite get it. So it does look quite good for Klima Energy if you just focus on the cash flows from operating activities. But that doesn't tell us the whole story. You also have to look, particularly for mining companies, look at cash flows from investing activities, because in this section, there is a property, plant and equipment, which is capital expenditure. And for the quarter, Klima Energy spent $12.3 million on that. And because capital expenditure was greater than cash flow from operating activities, Klima Energy was not free cash flow positive for the March quarter, which makes their capital allocation decision to issue dividends and share buybacks a little bit more interesting, because those sort of decisions should be made when a company is operational cash flow positive and, more importantly, free cash flow positive. At this point in time, Klima Energy is not free cash flow positive right now, but that could change. Another capital allocation decision a company can make is pay down or decrease debt. And it seems like one of the reasons this company raised some capital back in January or February is to pay down their debt. So I do appreciate this capital allocation decision by management. Debt has gone down from being over $20 million to $2.9 million right now. So that is a really good decision from management, in my opinion. With most mining companies, one thing I will look at is some of the metrics. So we're looking at production sales, financial, and realized prices. So the main thing companies don't have a control here is realized prices. For instance, oil has gone from 44 or $84.5 per barrel in Q4 to $108.5 million in the most recent quarter. So that has been really beneficial from Calima. Also, natural gas has increased and natural gas liquids have increased over the past quarter. So if we do see those prices go down in the next quarter, Calima Energy will be negatively affected by that. And that's one thing Calima Energy doesn't have control over. Another reason why this company had a really good quarter in terms of operational cash flow was because of those higher realized prices for oil, natural gas, and natural gas liquids. So this is the one thing that is negative about commodity companies or mining companies is they are price takers. They are not price makers. They have no control of what price they sell their products. I've already mentioned a couple of times that the company has announced that they will be issuing a dividend and performing a share buyback program. They made this announcement official. They were talking about this in the activities report for the March quarter, and they've made it official on the 23rd of May, 2022. Now, there was a little bit of a bounce in the share price, so the market did appreciate this news flow from the company, even though it was expected. When it comes to the dividend, the initial dividend will be $2.5 million, reflecting a half-yearly yield of 2.4% at the current share price. So share price back then was a little bit lower than it is now. The timing of the dividend, including the record date and ex-date, will be advised in due course. When it comes to the share buyback, the best time to do a share buyback is when the value of the company is low. And right now, in regards to whether this company is good value, if you just look at what the management think, you would say yes, because in this announcement, they actually stated the board considers that the company's current share price does not accurately reflect the underlying value of the company's assets, and the share buyback represents an opportunity to improve the value of the remaining shares on issue. That's absolutely true that a share buyback should be done when the company's value is low. Whether the company's value is low right now is up to you and me, not really up to the company's board. They could have they could be a little bit biased when it comes to what they think the value or valuation of this company is right now. So let's have a look at the chart for Calima Energy. And I've already mentioned that the energy sector has performed really well over the past 4 to 5 months. In fact, it is the best performing sector on the ASX and more than likely on most international exchanges. But when it comes to Calima Energy's chart, it does not look that healthy at this point in time. You can see around about September of last year, there could have been some sort of consolidation in the share price, because when you look past September last year, those candlesticks reflect a really low share price, say 0.1, 0.2 cents or something like that. When you go past September of 2021, that looks like a chart that you would see when the share price of a company is above 10 cents. So something really happened in September, August last year, but the share price of Calima Energy reached a peak of 27.5 cents in October last year and really has been falling ever since. In fact, I'd say right now the share price is in a downtrend. However, in saying that, the share price has risen from 15 cents to a current share price of 20 cents over the past 3 to 4 weeks. And really, when the company announced this dividend and share buyback, we did see the share price pop up on that day. But right now, 20 cents is significantly lower than we have seen over the past 9 months or so. So there's a lot of resistance moving forward for this company, and not a lot of volume over the past few weeks also when we've seen the share price rise. So not a lot of interest in the market right now when it comes to Calima Energy. The question is Calima Energy undervalued? The other question I have for this company, can they become free cash flow positive? Why were they spending over $12 million in capital expenditure? Was it to bring more assets online? That could be a possibility, and we might see capital expenditure actually decrease. And if we see capital expenditure decrease while cash receipts increase, as more assets come online, this company will be highly operating cash flow positive and free cash flow positive. And maybe that's the reason why the company's management have instigated a dividend and also a share buyback. That's all I have for this video on Kalima Energy. Really the first time I've looked at this company in depth, and a fascinating story when it comes to this company, in particular, that the company has started a dividend and share buyback program, which tells me that either the company is undervalued, that the company is becoming free cash flow positive, and that's the management of the company can see that, or the management are making all the wrong decisions. So if the company remains being free cash flow negative, a share buyback and a dividend policy would not be in the best interest of shareholders moving forward. If you do have any more insights in this company, I'd love to hear it. So leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.